cannot succeed in their missions without developing financial institutions. International institutions ready to jump in building capital markets. Deborah, allow me to attract you to the stage. And to complete the ecosystem, we have two sides. We have mortgage refinancing companies that have to be acting and develop stakeholders at the national level, but we need international support. We need common standards. We need the things. And I think, Deborah, it's an honor to have you here today. And thank you very much. And I'll let you invite your panelists to join on the panel as soon as you want. Thank you very much.
Come on up, everybody. So I'm going to use moderator's privilege and make a comment kind of along the lines of what Maria said, going back in history. Back when I was working for the Mortgage Bankers Association in the US, we had this big argument about what kind of secondary market solution works best for emerging markets. Is it securitization, you know, Fannie Mae, Freddie Mac, or is it Bausparkassen, mortgage bonds? And I don't think the question was ever solved, but at some point, I don't know exactly when it happened, people started saying, wait a minute, why are we talking about secondary mortgage markets when we don't even have a primary mortgage market? So just point to be said. Yes, I fully agree, and we're going to talk about capital markets here, with the caveat that there needs to be product to fill the demand for these securities. And there are risks associated with developing product simply for the purpose of providing collateral for asset-backed instruments. Anyway, that's just me talking. So I'm going to reintroduce myself. You obviously, you know Simon, you know Habib, you've met them. I'll reintroduce myself since I'm no longer working for DFC. I've gone out on my own and doing consulting and some other stuff in this space, but I'm also leading with the Affordable Housing Institute the creation of a new entity called Chrysalis, Housing Impact Accelerator, and we'll talk about that more at a roundtable tomorrow. But I'd like to ask Nema if you would introduce yourself, and Richard, and Palesa, because I don't know that everybody knows you guys as well.
Okay. All right. Hello, everyone. It's terrific to be here. This is my first time at an AUHF conference. And, you know, thanking Deb for inviting me to speak on this panel. I am the managing director of the Community Infrastructure Team, which sits under the Office of Infrastructure at the U.S. International Development Finance Corporation. And of course, if that sounds familiar, it's because I'm stepping into the shoes that Deb has left behind when she left DFC. So I'm heading up the team that focuses on affordable housing, supporting the affordable housing sector, the mortgage companies, as well as the mortgage refinancing sector, student housing, and other sectors within real estate, such as industrial, warehousing sectors, but areas within real estate that hold significant developmental impact. So certainly happy to be here. I'd spent about 7 years on the continent in South Africa, working on real estate developments in Eastern and Western Africa, so certainly very familiar with working in the property sector on the continent. Happy to be here.
Hi everybody, Richard Kemish. I don't work for a DFI, I don't borrow money from a DFI, so you're probably wondering what I'm doing on this panel. Yeah, I'm an interloper here. I think, yeah, my first thing is I spent about 25 years turning mortgages into bonds and selling them to boring German pension managers. And Luca was mentioned them. Some of my best friends are German pension managers, boring German pension managers. And if I can throw down a challenge for this conference for next time, there should be some boring Germans in the room, because they would have an enormous interest in everything that's going on here. If you look at yields that are available in the Eurozone, the sort of investments that they are able to invest in with the stability and the prudential treatment really doesn't work. It doesn't pay anybody's pension. If you look at the demographics, they really need to be here investing in this kind of stuff. And I think a lot of what we should do, and I count Luca and I count Farouk with his comments about covered bonds, should be about bridging that gap and ultimately, sorry guys, cutting the DFIs out of this process or moving on from that process into the capital markets. I said I did that in mainly Western Europe for 25 years. Then about 10 years ago, I had a conversation with with the EBRD, the European Bank for Reconstruction and Development. And they said, oh, what do you do? Cover bonds and securitization, what do you do? We developed local currency capital markets. It wasn't the lending arm of the EBRD, it was the capital market development arm. And in so many of their countries of operation, the story was, we have govy bonds and we have equities and nothing in between. Why would anyone allocate fixed income to this currency if there's nothing in between to invest in? They try to diversify, and I said, well, we've got a great product which is a great diversification. It's private sector, but it kind of looks quite a lot like a govy bond if you look at liquidity characteristics and credit characteristics. It could be a good substitute for govies, for bank treasuries and whatever. And after that conversation, I spent the next 10 years basically working in local currency capital market development, trying to do more covered bonds, trying to introduce covered bonds to regulators, to lawmakers, trying to do the education process. So coming back to the question of why I'm here, quite often I sit in a room with the lending arm of the development agency. Sometimes they help. Sorry guys, sometimes they really, really hinder the process of developing the capital market. And that's something that maybe we can explore a little bit later on.
That's tough to follow on, given that I am one of the DFIs. And I have a different view, but looking forward to unpacking that to actually substantiate that we actually are quite complementary, by the way. My name is Palisa Ryan. I'm from the DBSA. It's a DFI domiciled in South Africa and owned by the government, although we do have a sub-Saharan African footprint. The team and I look after social infrastructure that's funding projects in housing, from social housing across the spectrum to affordable housing. We look at student housing, healthcare at a primary as well as a tertiary level, as well as education. That's your primary, secondary, and tertiary institutions. Grateful to be participating on this panel.
Thank you all. So what we're going to do today is we're going to talk about DFI engagement in the supply side as well as the demand side of the value chain. Talk right into it. There we go. Okay, we're going to talk about supply side and demand side. We're going to start with supply side because we're going to lose Habib in 25 minutes. So we know that DFIs have had a reasonable amount of success dealing with the demand side. You just heard from the mortgage refinance companies, which have received support obviously from multiple DFIs over the years. And I know DFC has provided credit facilities directly to banks for mortgage finance, credit facilities to non-bank financial institutions. So that's been progressing, although there's more to be done, and we're going to talk about that later in the program. But right now I'd like to talk about supply side. And from your perspective, Habib and Palesa, can you talk a little bit about what have been the issues in funding development, housing development, infrastructure, land development, and how do you think the international DFIs might help you be more effective in those areas? You want to start?
No, thank you very much, Deborah, and thank you, colleagues, for having me on this panel. It's a pleasure one more time to serve. I think, it's really important, first of all, to put all this in the context of the role of DFIs, right? So DFIs, as the name implies, development finance institutions, they're supposed to facilitate and help drive investments in challenging sectors, difficult areas, such as housing and urban development. I mean, everybody who came before this panel kept talking about 20 years, 30 years of Maya is still in the room, still fighting for the space. So basically, these are very difficult and complex sectors, right? So it's important for DFI to get involved. And we've seen this in many other advanced markets. You look at the US, maybe they might not be called DFIs, but they are technically DFIs. The Fannie Mae's, the Freddie Mac's, the Ginnie Mae's, right? These institutions were set up by US government, for instance, to develop the mortgage market in the US. In Europe, you have similar institutions that were created. These are DFIs, if you think about it the right way, because they're all government supported, and you need that to get the market to get going, right? Then private sector would be mobilized, right? Private sector would then come in and understand the value of the sector. So I think the challenge really on the continent, in Africa in particular, has been that we don't have many of those institutions that are supposed to help mobilize that kind of capital and funding to the sector, right? So Shelter Afrique Development Bank was created in 1982, so that's 42 years ago. And 2 years later, AUHF, I'm very glad to see Sharon in the room, the founding member, in Nairobi as well, when Shelter Afrique was being established as well. So, you know, you don't have many of such institutions. So you have this one single institution that was created to address financing in a concessional and affordable manner to the whole sector across Africa. And such an institution was capitalized by governments, not so much by any other sort of financiers, but government. And you had maybe some of the bilaterals that were kind of involved at the beginning, but the resources are mainly equity capital from the governments, right? So when we came on board a year and a half ago to address your question, Deborah, we thought it was really critical to mobilize international funding from other multilaterals, right, to really push the agenda. And we are very glad to see that USDFC has been pretty much involved with some of these institutions that Shelter Afrique actually set up historically. CAHF in West Africa, there was a bond issuance in the US pension funds guaranteed by USDFC. And I think recently we heard TMRC is working towards that. NMRC closed the transaction already. So these are all investee institutions of Shelter Afrique Development Bank, right? So what we do is really to create those apex sort of institutions and help mobilize resources globally, internationally into the space. So we're very glad we get into that space today, where USDFC and others are getting more and more involved into the space. And the other challenges are really access to local currency, because housing is a local currency play. So it's very difficult to use foreign currency, hard currency, to finance a local consumer product, right, or local production product, right, a local product, basically. So to really find mechanism for hedging the foreign currency you might be getting from international financiers could be a challenge. And this is some of the things that USDFC also helped address, right, by providing those kind of cover for funding CRH in West Africa, the Mortgage Refinance Company of the WAMU countries, you know, maybe the one in NMRC and other countries in Africa. So it's important to provide those de-risking facilities to really help jumpstart these markets. So we at Shelter Afrique Development Bank, we have set up a whole new unit. We call it the Fund Management Group, FMG. So we have 4 main pillars today. We have FIG, which is Financial Institution Group, so we lend to financial institutions. We have PFG, Project Finance Group, lending to developers, large-scale construction companies. Then PPPs with government agencies, and urban regeneration and renewal is part of that unit as well. And the 4th one is this Fund Management Group, which is a specialized unit which will be mobilizing concessional funding so that we can blend with our private capital funding, right, from the capital markets, because we issue bonds also in different capital markets. We issued 46 billion naira in Nigeria out of a 200 billion naira program a couple of years ago that we're deploying in the market. So we need to take those market-driven source of funding to blend with sort of concessional funding that we can get through different DFIs globally. And we have 7 thematic areas which are impact-driven. So we have green climate resilience, green climate resilience, gender, housing for women, and women work in the housing value chain, financing them through MEFIs, infrastructure for basic infrastructure, trunk infrastructure, access to water, electricity, etc. We have SME and trade for job creation. We do have migrant and refugees, housing for them, and creating jobs in the value chain for those categories of populations. And diaspora funding is also key for everything that we're trying to do to mobilize foreign currency within the countries and get access to housing for the diaspora. So we look at the whole ecosystem that way, and we can have those funds set up as thematic funds and mobilize international capital, right, to drive the investment in the space.
Palesa?
Yes, no, thank you. So the DBSA has historically been, especially from a South African perspective, very well entrenched in the municipality as well as the metro funding space. And what we're now starting to see, certainly in the provision of social infrastructure, are the challenges that have been brought about by the unavailability of bulk, as enabling. So we've started to look at a number of innovative funding solutions, particularly off balance sheet, that we can leverage off of because one, the metros themselves can't borrow, and where we are seeing private developer clients wanting to step into that gap, they themselves then are hamstrung by the size of their own balance sheets to be able to respond to that as a start. And secondly, that isn't their core business. So we see ourselves, compared to commercial banks as an example, as being quite key, as being that party that can speak to both the public sector and private sector in solving for that. And I think that's quite a key critical role that a DFI can play as opposed to a traditional funder. And I'm trying to avoid making eyes with Umfundo there, who represents one of our commercial banks. We also appreciate that we can't be all things to everybody, and so we really leverage off the strength of our partnerships and that we rely on other local players. We've got NHFC in the room as well as TAF, who are clients of the DBSA. They service a segment of the market more on the smaller micro side better than us, and so we extend lines of credit to them, and we adopt a similar approach when we look at the region as well, to the extent that we're busy with this facility that we're looking to extend to Shelter Africa as well, appreciating that it's very important to have strong relationship with local players on the ground who appreciate the risks and the opportunities and can respond to them a lot more agilely than we can, all the way from Johannesburg. So I'll leave it there for now. Thanks.
Thank you, Palesa. So Nema and Simon, each of you, obviously Nema, DFC works in the private sector, World Bank is more public sector focused. How do you see this relationship between, local development banks and the international development banks? Is there more that could be done there? I mean, do you feel that this is, my gut feeling is you have a chain of intermediaries before the money gets to where it needs to go. Is that a problem? What are your thoughts about what's the best way to manage this?
Sure. I mean, there's certainly more that can be done. I mean, one thing that, from the World Bank side, it's a useful sense check that I kind of remind myself regularly, is that we're lending to governments. So the governments have to repay via their taxpayers. So it's not World Bank money, it's not us kind of doing anyone a favor, it's actually the countries themselves and their taxpayers that are on the hook to repay it. So to Richard's point, I think we want to be cut out of the system. We want, paradoxically, to be in a position where the country graduates and doesn't need us anymore and can stand on its own 2 feet. So that's the objective. I think the other point about the supply side, I think it's a good one. I think we've certainly learned a lot of lessons from some of our projects, and I think Kenny spoke about it for NMRC. I think we got the similar story that Joe spoke to for KMRC. That we realized demand doesn't create its own supply. Stimulating the demand doesn't fix the upstream problems with developers, with land, with building materials. And I think part of the problem, certainly on our side, on the supply side, it's very difficult to work with issues around land. Anything where you start breaking ground in a project entails all sorts of what we call safeguards. So looking at, are there squatters on the land? Is there a true, genuine title to the property? And this can take years and years to resolve. So it's very difficult to get involved on a systematic basis with those problems. Having said that, I mean, there's definitely ways forward. And again, I hate to suggest more regulation, which I think generally you want to go the other way. But equally, I've seen in India, the Real Estate Regulatory Authority has had great success in really developing and formalizing and making developers more creditworthy and credible from a position where they had very bad reputations. Saudis and another country, again, very different, but they've kind of brought the best of all different systems, and they've got a really good regulatory framework for developers. The same in the UAE. So that's one approach to really modernize and develop the supply side. And I think the other one is, I mentioned in my presentation, kind of public-private cooperation approaches, not necessarily PPPs. And we had the AUHF meeting in Cairo 2 years back, I think. And our best project where we do have an impact on the supply side, which I'm working with Maya, is one where we do provide subsidies on the demand side, but the way it's set up, there's a coordination body, the Social Housing Mortgage Finance Fund, which effectively commissions developers to build houses. And they're delivering 100,000 units per year. There's not another World Bank project that comes close to that level of delivery. So I think, come back to your question, sorry, on the kind of the link between World Bank or others and local DFIs, I think, yeah, our role is to try and empower them and us to be able to then step back a bit. I think that the local DFIs have also got the power to step in more at the project levels and do both the public financing and private financing aspects, financing of infrastructure, the last mile infrastructure, working with power companies, water companies, and so on. That's very difficult to do at a high level kind of World Bank project. So, yeah.
Okay, and I'll just add to that. I think this is certainly a very poignant question, and I certainly agree that there could be more collaboration. We can work closer with the local DFIs. What Habib has mentioned is that these are very complex structural issues that need to be resolved, and complex problems need complex or sometimes simple solutions that may seem complex at the outset, such as long-term permanent capital. And so that's one way that the DFIs are very effective, and particularly DFC, is that we come in, we're working with the private sector in low-income countries, lower middle-income countries. Africa is actually the largest segment of, or takes on the largest of our commitments. We have about $40 billion of commitments, over 10 billion in Africa, because that's where we have the largest concentration of the lower income, lower middle income countries that are tackling complex problems. And so, coming in, our ability to provide long-term capital and mostly fixed rate capital to create this foundation that can address the challenges that are faced in these countries, and particularly with regard to the supply side of housing. And so I think there is definitely that benefit that we bring. There's also the de-risking of projects that we bring to the table in terms of our ability to provide political risk insurance for projects, and also to provide guarantees and creatively structure local currency financing. So whether it's in the form of providing guarantees to banks so that local banks can then on-lend or lend to the suppliers of the housing industry, or creating structures that allow for local currency funding to be provided to these projects. I would say in addition, we look at crowding in local financing, because at the end of the day, yes, we are going to basically work ourselves out of a position here. The goal is not to be here permanently. Again, the goal is to create these private sector solutions that raise the standards of living, raise the economies in these countries. And so, yes, we attempt to stimulate the private sector, crowd in local financing, increase the capacity of local financiers to take on these projects and finance these developers. And so that's, at the end of the day, the goal is to, just have the local financial markets step up, grow, and be able to, cater to the economy.
So can I ask let's talk about risk quickly. A lot of what we talk about in the context of, the building, kind of what you were saying, Simon, you got all these regulatory issues, you have, macroeconomic issues. None of those things are in the control of your, average housing developer. And so let's say the local players, local banks, are not willing to lend into the sector in the face of all of those challenges. DFIs, arguably, that's their additionality. They should be willing to step in and set aside the macro risks, say, okay, we exist to accept that risk. What are the other risks at the developer level or the project level that you think need to be addressed in order to get more financing moving into the supply side of the chain?
And again, I apologize, I know there's a lot of developers in the room, but the challenge with developers, and this again, it comes back to why I suggested having a regulatory framework, is the developer sector in many countries is often very opaque. It lacks transparency, you're not clear on the ownership, they lack creditworthiness, which is why the banks, there's no point in just accepting risk of whatever quantum. I think first do what you can to reduce that risk, and then look at how it can be mitigated. So again, comes back to improving the supply side, finding some way of having either a voluntary registration scheme or a mandatory regulated one. I think that's kind of definitely one step forward. And then beyond that, I think there's other things. I mean, Oscar spoke yesterday about TMRC actively getting involved in looking at refinancing loans for developers and getting those financial flows. And that's kind of almost then an opportunity. You set minimum standards. A developer has to meet a bar beyond which it is then kind of becomes creditworthy. But a lot needs to be done, I think, on that front.
On the DBSI side as well, we're looking to be more aggressive in the private developer lending space, although it's still fairly nascent, compared to how we have been lending previously into the human settlement space. And so if I think of the value chain that we bring as a DFI, it's quite comprehensive and holistic in that over and above the provision of funding, we also have what we call our project preparation division, where we can assist clients with planning as well as project preparation facilities. So that goes a long way, towards de-risking the projects that we ultimately then want to fund. What we also do, particularly in the affordable housing space where there's the perception of market risk, is to partner with providers like your FNB who can come in with the demand side financing because we play on the supply side. So we do look at a number of risk enhancement instruments and partnering with the relevant players so that we can look at how do we de-risk that whole value chain from the project development to the funding as well as offtake.
Sorry, just one other quick point that I've just thought about, the kind of supply side versus demand side. One of the challenges we also have on the supply side, if you provide money and presumably it's concessional, it's very difficult to have that line of sight from the concessional money to who actually benefits. And the truth is, if you do that on the supply side, you make developers rich. You may have some benefit for the households, but it's much easier on the demand side to really target it, set an income limit. If you do subsidies or concessional financing, you know it's going straight to the household. That there's some erosion if you're financing the supply side, which is challenging to fix. There's no obvious solution on how you get it clearly directed.
Yeah, so just to add to it, I think we're looking at tackling that supply side by providing liquidity in that secondary mortgage market sector. And so, I think at the outset, developers, et cetera, cater to higher income housing customers because those are the guys that are going to get mortgages or can pay cash. And the lower, more affordable segment, have historically been denied access or been unable to access mortgage financing to purchase the homes. So that therefore feeds into the cycle of developers not creating or constructing homes to suit that target market. So addressing the secondary market as well as the mortgage market segments that focus on affordable housing, we've done that at, in Nigeria with NMRC, working on a lot of projects, direct funding to mortgage companies in India, in Tanzania, et cetera. And so addressing that segment of the population, we anticipate or hope, will spur that development of housing that focuses on the more affordable buyer.
I think it's a challenge to talk about these issues in silos, right? So it's not that we're going to address the supply side without talking about the demand side, or we're addressing the demand side without talking about the supply side. We have to look at this as an ecosystem, sir. Deluca. So it's an ecosystem that we need to address from an integrated perspective. And Simon knows this pretty well when we were coming up with this global World Bank group affordable housing strategy. What we realized over the years is that different departments were looking at housing in silos, right? So the impact that you would expect after 30, 40 years of work is not really what you want to see, right? So I think it's really critical for us to address this chicken and egg sort of situation, supply or demand, right? So the way we think we might have an opportunity to do something as Shelter Afrique Development Bank is creating this ecosystem where we create a ring-fenced sort of solution, right? Addressing specific matters such as staff housing programs, right? Which is a closed loop where we are addressing both the demand side, we are aggregating demand from employers, right? They have employees that need housing, etc. And then we look at the supply side, we identify strong developers that are clients of ours that we've been working with in many other countries and mobilize concessional, DFI, international funding or guarantees to de-risk that ecosystem and address everything at once. But we can't, it's going to be very difficult because today we have all these mortgage refinancing companies that are fantastic, have been set up for years. I think TMRC is the oldest one on the continent now, 10 years celebration. So I think, on the demand side, we've done a lot, to be frank, and understand when my ex-colleague Simon talks about the fact that we don't want to subsidize the developer because the money doesn't end, you know, in the hands of the household. But the way to address that, because somehow you have to work with developers, because today that's the challenge we have, right? I mean, TMRC and others, everybody want to find a way to work with developers because that's the challenge today. So how do we address that? So on our side, we're thinking about talking to different partners on this panel and others to set up something that would address that. Almost like a refinancing scheme, right? Working with the developers, kind of similar to this mortgage refinancing on the mortgage demand side, but we're getting requests from many countries now to create similar instrument that would address the developer's side. Now, we have to put all the checks and balances to make sure that at the end of the day, right, it's gonna benefit the end user, right, on the demand side. So those are some of the things that we're looking at. Employer staff housing programs, as I said, the funds that we're setting up that will be more like looking at the whole ecosystem on both sides at the same time.
Yeah, I agreed, but my sense of the African market, first of all, everybody talks about Africa as if it's a country, and it's 5 minutes, right? And we need to hear from Richard. I think that some of the examples that are presented to us are much more aggregated markets that have centralized controls, centralized regulation, or government drivers that create homogeneity within the markets and enable some of these more traditional mechanisms. But I don't think that's the only mechanism in these countries here in this continent. And that's the challenge here. So Richard, turning to you.
I guess I want to say something about the developer subsidy thing. I don't know how long it takes to build a house. Presumably very different in very, very different environments. It takes 25 years to pay for it, though. And I think one of my points is, so let me backpedal a bit. When I was in an investment bank, the balance sheet was the most expensive, closely guarded thing imaginable. And if I had to use it, I put on my best tie, I went down on my knees and asked for the credit controllers to use balance sheet to generate income. And after asking, am I going to get my money back, the second question was, when am I going to get it back? Can I make it any sooner? And everything was structured looking at an exit strategy. That's the fundamental first decision. And I don't know how applicable, I know nothing about development finance, but I don't know how much it can be, we'll fund the building of this property, where's the exit strategy in the capital markets? And that's a kind of a basic thing, I guess, that I would say. And probably have to price the balance sheet, price the funding much more expensive than it actually is at the moment. Development banks price incredibly cheaply. They have a relatively low cost of capital compared to the private sector. It's an implicit subsidy when you lend compared to the ultimate takeout.
Paradoxically, no, we aren't typically cheaper than your banks, and it's a function of how we raise our own funding, right? We aren't deposit taking, as an example. And I think this is where it becomes very important when you look at a project where you want to use DFI capital versus commercial capital, so that a DFI can price appropriately for the risk that they would take up front. It's a market failure that we actually should be trying to solve for. And that's where the participation within the bulk infrastructure financing comes in, or participating within the construction phase of a project when most people don't want to take that risk. And again, it becomes quite important to have mechanisms to refinance the debt. Most DFIs won't participate as refinanciers. Again, because there isn't additionality, we haven't been able to demonstrate, if we did that, what the development impact of our money was. So that's why I say I think it's very much a symbiotic relationship when one looks at the continuum of funding and players in that space. And it's just knowing when to slot in which participant for best value.
Okay, so the takeaways. Yes, ma'am.
Deborah, we're talking about the cost of construction. are we taking into account what is really happening on the ground in Africa? The mafia, the protection rackets. You may say a house costs 100,000, whatever your currency is. And then comes somebody who says, unless you pay me, Mr. Developer, 20% or 10% of the construction of your house, you will not be allowed to continue to develop this house. To what extent is this affecting construction costs, and what is being done about it in Africa right now? I know that this is a big factor in South Africa right now. And let's be real about the construction cost, factoring in what is happening in terms of protection rackets.
Point well made. We should have a panel on that. For today, what I'll say is that I think the takeaway here is we have a lot of different categories of demand. We should perhaps try to work together to match supply to those types of demand support, kind of like, Simon, what you were talking about was done in Egypt, so that there's more direct, specific alignment to specific pockets of demand. And so it would be interesting to see whether the international DFIs working with the local DFIs would be able to brainstorm ways to put packages of funding together, working with the private sector partners to address those combined, those mini ecosystems, if you will. All right, that's on the agenda, Kesia. Thank you all so much.
Thank you, Deborah, and thank you to all the panelists. Like this, we have discovered our ecosystem. We wanted to set the scene for your lunch. Like this, you know exactly who is doing what we can do all together. I mean, you have the market side, you have the public sector, and you have all the right stakeholders to make something new and different. Just some logistic information, housekeeping. I mean, first of all, we will give the publication to all the speakers, but also, we, together with CAHF, we try to organize something new this year. Well, try to enjoy the garden. We thought, why, and we wanted you to debate, to find solutions. So we are offering you two things this afternoon. You can enjoy the air conditioning here, listen to us, and continue to, but if you want to approach the pool, but not yet the pool, there is the garden in between, and we organize some kind of a garden discussions, where actually you can check by scanning your QR on your badge, the agenda, and we have organized 3 debates. Just for the ones of you who would like just to be a bit deeper in the debate, I think, Maria, you will be part of the show, and we will have different kind of discussion this afternoon and tomorrow. So we invite you to join also this kind of debates. It's just if you want to go a bit deeper. Here we try to give you an overarching view, but we are trying to, it's a tentative. Let us know if you like this kind of approach, but in the garden you will find kiosks where you can actually discuss. So, good food for lunch, good food for thought afterwards.